Yesterday, at exactly 9:03 a.m. New York time, the global financial system blinked. Gold didn't just break $4,200 an ounce. It shattered a psychological ceiling that the biggest central banks in the world have spent the last 50 years trying to reinforce. Turn on the television right now, and you will hear the pundits calling this a bubble. They are calling it market hysteria. They are telling you that the price is irrational and that you should take your profits and run back to the safety of the dollar. But if you shut out the noise and look beyond the headlines, if you open the dusty accounting ledgers that have been closed since the late 1970s, you will see a terrifying pattern emerging. This isn't a bubble. This is the exact same stage 4 signal that flashed in January 1980, right before the greatest transfer of wealth in the 20th century. The last time the charts looked exactly like this, the US dollar lost nearly half of its purchasing power in a single decade, and the middle class was decimated. The system isn't growing. It is dying. And what happened yesterday wasn't a trade. It was an exit strategy being executed by the very people who tell you everything is fine. To understand why $4,200 is the number they fear the most, we have to travel back in time to a crime scene that most historians have forgotten. We need to look at the 1980 ledger. Most financial history books will tell you that the 1980 gold spike to $850 was caused by two brothers, the Hunts, trying to corner the silver market. That is the official story. It is a convenient lie designed to make you think that asset prices are driven by greedy speculators. The truth is hidden in the shadow ledgers of the Federal Reserve. In 1980, the world didn't trust the dollar because inflation was running hot, hitting nearly 14%. People were panic buying hard assets because they could feel their paper money melting in their pockets. But here is the twist that nobody is talking about today. In 1980, the United States had a national debt of roughly $900 billion. The debt-to-GDP ratio was around 30%. The country was solvent. The Federal Reserve, led by Paul Volcker, had a weapon they could use. They had the ledger space to raise interest rates to 20%. It was painful. It caused a recession. It crushed businesses. But it worked. Volcker raised rates above the rate of inflation, made the dollar attractive again, and crushed the price of gold for the next 20 years. That was the 1980 solution. Now, look at the ledger of December 2025. The price of gold has just signaled that inflation is back, but the math has completely changed. Today, the U.S. national debt is not $900 billion. It is approaching $40 trillion. The debt-to-GDP ratio is over 120%. This is the mathematical trap that they cannot escape. If the Federal Reserve tried to do what Paul Volcker did in 1980, if they tried to raise interest rates to even 10% to stop this gold rally and save the dollar, the interest payments on the national debt would exceed the entire tax revenue of the United States government. The country would be insolvent by Friday afternoon. The banking system, which is sitting on trillions of dollars of unrealized losses in treasuries, would collapse instantly. This is the secret they are hiding. They cannot stop the gold price this time. They have lost the only weapon they had. In 1980, they had a brake pedal. In 2025, the brake line has been cut, and the car is accelerating downhill. This is why $4,200 is not the top. It is the starting gun. When you realize that the central banks cannot defend the currency with high interest rates, you realize that the currency has no floor. The value of the dollar can effectively go to zero against real assets. This is what the smart money figured out yesterday. The spike we saw wasn't retail investors buying gold coins. It was institutional capital realizing that the Volcker solution is mathematically impossible. They are looking at the same ledgers we are, and they see a gaping hole where the assets used to be. But the story gets darker when you look at who is buying. For the last 12 months, we have seen a peculiar anomaly in the gold market. The price has been rising even when real interest rates were high, which defies traditional economic theory. Usually, when rates are high, gold falls. Why was it rising? Because there is a hidden buyer that doesn't care about interest rates. If you track the physical delivery numbers from the London Bullion Market Association and the Shanghai Gold Exchange, you see a massive flow of metal moving from west to east. While American and European investors have been selling their gold ETFs to buy tech stocks and AI companies, the central banks of China, Russia, India, and Saudi Arabia have been draining the physical vaults. They are not buying paper contracts. They are taking possession of the bars. They are removing the collateral from the Western financial system. This is a coordinated run on the bank, But the bank is the United States dollar. In 1980, the United States was the world's largest creditor. Everyone owed America money. Today, America is the world's largest debtor. When the creditors, the nations that hold our debt, decide to swap that debt for gold, the price doesn't just go up. It goes vertical. We are witnessing the end of the exorbitant privilege of the dollar, not through a war, but through a silent accounting adjustment that most people won't understand until their savings are wiped out. Let's go deeper into the numbers, because beyond the ledgers means we don't just look at the price, we look at the ratios. There is a historical ratio that has predicted every major financial reset since the Panic of 1819. It is the ratio of the gold price to the monetary base. In 1980, at the peak of the mania, gold covered more than 100% of the U.S. monetary base. The market forced the government to implicitly back the dollar with gold. Today, even at $4,200 an ounce, gold covers less than 20% of the monetary base. To get back to the 1980 levels of coverage, to restore faith in the currency mathematically, gold would not need to be at $4,000. It would need to be at nearly $25,000 an ounce. I know that number sounds insane. It sounds like hyperbole. But remember, in 1971, gold was $35. If you told someone in 1971 that gold would hit $850 in 9 years, they would have called you a lunatic. They would have said it was impossible. But it happened. Currencies don't die in a linear line. They die exponentially. They hold their value for decades, and then they collapse in weeks. The scary part is that the mechanism for this collapse is already built into the system. It is called the everything bubble. Since 2008, central banks have printed money to suppress volatility. They have bought bonds, mortgages, and even stocks to keep the illusion of wealth alive. But by doing this, they have destroyed the price discovery mechanism. No one knows what anything is truly worth anymore. Is your house really worth $1 million? Or is the dollar just worth less? Is the stock market at all-time highs because companies are profitable, or because there is too much currency chasing too few shares? Gold at $4,200 is the first honest price signal we have seen in 20 years. It is the market shouting the truth that the politicians are whispering. The truth is that the debts cannot be paid. There is no tax rate high enough, no spending cut deep enough, and no growth rate fast enough to pay off $36 trillion plus $200 trillion in unfunded liabilities. The only way out is default. But governments don't like to default openly. They don't like to tell voters that they are bankrupt. Instead, they choose the soft default. They choose inflation. They choose to pay back the bondholders with currency that is worth half as much. This is why they are terrified of gold. Gold exposes the soft default. It acts as a report card for the central bank. When gold makes a new all-time high, it is failing grade for the Federal Reserve. And right now, the Fed is failing historically. This brings us to the most dangerous part of the 1980 replay, the reaction of the government. In 1933, when investors started fleeing the dollar for gold during the Great Depression, Franklin D. Roosevelt didn't fix the economy. He confiscated the gold. He issued Executive Order 6102 and made it illegal for American citizens to own monetary gold. He forced them to sell it to the government at $20 an ounce, and then he immediately revalued it to $35, effectively stealing 40% of the people's wealth overnight. Could it happen again? The skeptics say no. They say the gold market is too small to matter now. They say Bitcoin is the new gold. But look at what the Bank for International Settlements, the central bank of central banks, is doing. They are reclassifying gold as a Tier 1 asset for banks. They are encouraging banks to hold gold just as they are preparing to launch central bank digital currencies, or CBDCs. A digital currency gives the government total control over your spending. It allows them to apply negative interest rates, to expire your money if you don't spend it, and to track every transaction. But a digital currency only works if you cannot exit the system. If you can take your wealth out of the digital dollar and put it into physical gold, their control is broken. Therefore, as gold skyrockets past $4,000, the risk of capital controls increases. We might not see a door-to-door confiscation like 1933, but we could easily see a windfall profits tax on gold sales, or a ban on buying physical bullion with cash. The window to secure your lifeboats is closing, and the price action yesterday tells us that the smart money is rushing through that window right now. Let's analyze the Minsky moment. Hyman Minsky was an economist who described how stability leads to instability. He argued that during good times, investors take on too much risk, assuming the good times will last forever. Eventually, the debt becomes so large that the income generated by the assets cannot even pay the interest. This is the Ponzi stage of finance. We have been in the Ponzi stage for over a decade, funded by 0% interest rates. But now, rates are up, and the bill is coming due. The commercial real estate market is collapsing. Regional banks are zombies, kept alive only by government lifelines. The gold price is sniffing out this rot. It knows that the Federal Reserve will have to print trillions of dollars to bail out the banks, the real estate tycoons, and the pension funds. Every time they print, the denominator of your wealth gets larger and your share gets smaller. Gold is simply adjusting to this new supply of paper. You have to ask yourself, why are the wealthiest families in the world, the ones whose names are on the buildings and the museums, quietly buying farmland, commodities, and gold? Why are tech billionaires building bunkers? They are not crazy. They are historians. They know that every fiat currency in history has eventually returned to its intrinsic value, zero. The Roman denarius, the French assignat, the German Papiermark, the Confederate dollar. They all followed the same pattern. Excessive debt, currency debasement to pay the debt, loss of confidence, and finally, hyperinflation. The United States dollar is at the end of that cycle. The $4,200 price tag on gold is not a fluctuation. It is a siren. But there is another layer to this ledger, the geopolitical layer. For 50 years, the US dollar was backed by oil. The petrodollar deal with Saudi Arabia meant that if you wanted to buy energy, you had to buy dollars first. This created a permanent demand for US currency. But that deal is dead. Saudi Arabia is now selling oil to China for yuan. They are joining the BRICS alliance. The demand for dollars is drying up just as the supply of dollars is exploding. When those dollars that are held overseas come flooding back home because nobody wants them anymore, we will see domestic inflation that makes the last few years look like a picnic. This is the Triffin dilemma playing out in real time. The US had to export dollars to run the global economy, but now there are too many dollars out there, and the world is sending them back. Gold is the only asset that is not someone else's liability. It is the only asset that is not a claim on a bankrupt government. The media will try to distract you. They will talk about the stock market hitting new highs, ignoring the fact that in real terms, priced in gold, the stock market is actually crashing. If the Dow Jones goes up 10%, but the currency loses 20% of its value, you have become poorer. This is the money illusion. It is the trick that keeps the population calm while their wealth is stolen. In 1923 Weimar Germany, the stock market went up millions of percent. Everyone thought they were rich. But the price of bread went up billions of percent. They were starving billionaires. We are seeing the early stages of this phenomenon. The numbers on your screen are going up, but your grocery cart is getting emptier. The gold price is the only thing telling you the truth about your purchasing power. So what happens next? If the 1980 ledger is truly replaying, we are about to see a period of extreme volatility. The powers that be will try to smash the price of gold. They will dump paper contracts on the COMEX market in the middle of the night to trigger stop-loss orders. They will release statements saying that the economy is strong. They might even change the CPI calculation again to hide the inflation. But these are temporary measures. They are trying to hold a beach ball underwater. Eventually, the physics of the market will take over. The physical shortage of metal is real. Mines are not producing enough to meet demand. The grades of ore are declining. It takes 10 years to open a new mine. The supply cannot respond to this price. And when a short squeeze hits a market with no physical inventory, the price doesn't just double. It can go up 5 times, 10 times. We are standing at the precipice of a new era. The era of the unbacked fiat dollar is ending, and the era of asset-backed currencies is beginning. The transition will be chaotic. It will be violent for those who are unprepared. Millions of people will look at their bank accounts and see numbers, but they won't be able to buy anything with them. But for those who read the ledgers, for those who understand history, this is not a disaster. It is an opportunity. It is a chance to position yourself on the right side of the wealth transfer. The signal has flashed. The price has crossed the line. The 1980 pattern is active. The question is not what the Federal Reserve will do. We know what they will do. They will print. The question is, what will you do? Will you stay in the burning theater hoping the fire is transitory? Or will you find the exit before the crowd stampedes? The ledger is open, the ink is drying, and the balance is due. The $4,200 signal is the final warning. The next move will not be a signal. It will be the event. History does not repeat itself, but it rhymes. And right now, the rhyme is sounding a lot like a funeral march for the paper dollar. Plan accordingly.